Good morning, everyone. It is an absolute privilege to be here and to moderate such a distinguished panel of speakers. I'm Kavita Menon, Director of Singapore's Sustainable Finance Association. We are a cross-sectoral industry body set up by MAS along with the financial sector with the mandate to develop sustainable finance ecosystem in Singapore. And on the panel today, I have with me industry leaders and seasoned practitioners who are driving the climate finance agenda globally. So Danny, Joe, and Anthony, thank you for joining us today. So maybe a bit of context setting before we get started. We've heard from the previous speakers that decarbonizing Asia's energy sector is central to achieving global net zero ambitions, as the region is both a major emitter as well as a key driver of future energy demand. But this energy transition in Asia must be done quickly and effectively while ensuring the region's energy security, affordability, and accessibility. However, according to IEA, high real and perceived risk limit private capital mobilization for energy transition in Asia. If you look at the cost of capital for clean energy projects in emerging markets, is 2 times higher than advanced economies, with country and currency risk accounting for 2/3 of this increase. So in this panel, we are going to focus on innovations that are already happening on the ground. We will spotlight the de-risking mechanisms that are currently being utilized for clean energy projects and which are used for unlocking private finance at scale. So with that, I would like to now kick off our discussion with my first question to the panelists. So we've heard from the conference from yesterday and today on the significant barriers, be it policy, regulatory, financial, or even market-based, that is limiting flow of private finance. In your view, what would be some of the critical systemic changes that is required to unlock this flow of capital? So Danny, if I may start with you.
Well, first of all, thank you very much indeed for the opportunity to be part of this panel. I think the questions that we're addressing here are fundamentally important. For HSBC, we are seeking to scale up substantially our infrastructure business, driven by the opportunities here in Asia and beyond that come from the net zero transition. You know, with perhaps $1.7 trillion per year of investment needed in Asia, the opportunities are huge, and so solving some of those barriers are critical. I think fundamentally what it's about is getting all the different aspects of the financial ecosystem to work together. So I'm sure we'll talk about blended finance, getting public and private to work together. For commercial banks, I think we need to increase the velocity of circulation of our capital so that we can get that capital back into the next project rather than tying it up for a long time with those assets. That means how we work with blended finance, how we work with insurance, how we work with asset holders who want to hold assets for the long term is absolutely critical. I think one of the points that Mary Shapiro just made is really important, which is about capacity building and knowledge. You know, I think a lot of investors hold back from emerging markets because of their perception of risk or perhaps lack of understanding of really where the opportunities are in those markets. So building capacity is critically important. And then I think we also have to expand the pool of bankable projects that can be financed. And I think that's another area where blended finance can play a crucial role. And then there are regulatory barriers as well. Sometimes I think that as new innovations come that can drive forward sustainable investment, they also need to be recognized, especially when they have real value in terms of de-risking the business. They need to be recognized by financial regulators so that banks and others are incentivized to use those mechanisms and therefore achieve this global goal of scaling up this investment. Before coming to HSBC, I worked in a multilateral development bank, and a lot of the talk there was about mobilizing the private sector. I think from the private sector point of view, we have to talk more about mobilizing the public sector so that together we can deliver the opportunities that are there.
Thank you, Sir Danny. I see a lot of threads of conversation there, but emphasis on that capital recycling part of it. Joe, how would, from Rockefeller Foundation's perspective, what do you see as some of that systemic changes that's required?
Thank you, Kavita, and good morning to everyone. It's great to be back in Singapore with so many important partners and friends. I suppose from the Rockefeller Foundation perspective, our starting point is that everybody deserves a future of opportunity, be that the opportunity to have good food, good health, good jobs, or access to reliable and affordable power. And for us, we realize, as Mary Shapiro also said, that clean increasingly makes sense from an economic and a development perspective. But we must be realistic. Coal still dominates power systems in the region. But we know from real world data, from projects we're working on in markets across the region, that clean really does make sense. Solar PV and storage in particular can provide dispatchable power at competitive prices. And clean can meet these two important criteria of affordability and reliability. And these are the two drivers of power system development in emerging markets and developing countries, and everywhere, in fact. And that's even without getting into the co-benefits, that have been discussed at length already, so I won't repeat. To get back to your question about challenges, there are obviously many, but I wanted to highlight one in particular, and that's the challenge of mindsets. Mindsets have not kept pace with the innovations that we're seeing in finance, which we'll discuss on this panel, with innovations in technology. And that's why at the Rockefeller Foundation, we're really focused on show, not tell. We want to seed pilot coal-to-clean projects in key markets across the region that can have a demonstration effect that can show these benefits in practice, particularly affordability and reliability. And our goal is to do 100 of these projects across the region by 2030.
Absolutely. So show, not tell, taking on that thread. Like Anthony, from you respect the voice and represent the voice of the insurance sector here, and you have a very, very big role to play within the clean energy ecosystem. What do you see from your perspective as some systemic changes that needs to happen?
Well, thank you. I mean, as you know, we started this conversation in the Singapore Pavilion in Baku back in November. So it's great to be here now in Singapore, continuing that conversation, I think, in this critical region. And I think, make no mistake, if we are to achieve our goals in the energy transition, in net zero, in addressing, let's not mince our words, the global climate crisis and the emergency that we face. Asia, Southeast Asia, is pivotal to that, and the role that I think Singapore in particular plays, I think, as a hub that brings critical expertise together, like finance and banking and law, but also insurance, I think can play an incredible role in leveraging money in global financial markets and that expertise. But for someone like myself who's been in this space for over 30 years, in the climate finance space, I think one of those aha moments over the last couple of years is that we've had a massive blind spot, which is insurance. That it is one of the major missing jigsaw puzzle pieces between the money, and there's more than enough money in the world, we know that, and the technology. We have the technologies. And if you talk to the money side, they say, we've got the money, we've made the commitments. I mean, HSBC's made a commitment, 5 trillion by 2050 of climate finance, and many of the banks and others have similar commitments, as do governments. But the major hurdle that I think everyone is facing is risk and risk hurdles, and how we address risk. And it's the insurance industry that should be playing its part in doing that. It's got very good at pricing risk, probably in a very defensive, reactive way, so it doesn't lose money and prices things properly. But we believe at Howden that it needs to do more, that we need a paradigm shift. We need an industry that is proactively de-risking the resilient net zero transition and unlocking, enabling, if you like, those flows of climate finance. I mean, credit insurance, for example, and other types of insurance, they can reduce the cost of capital for these projects. And indeed, I think as we were discussing, increase the amount of capital that's available and allow that capital to flow faster and be recycled, much faster. And I think that is critical. In a sense, what we're talking about here is efficient risk sharing, which means effectively utilizing, I think as we said, again, sorry, Danny, to quote you again, but utilizing all parts of the financial system and the balance sheets that are available. And the insurance industry is not something separate from finance. It's an integral part of the financial markets. We could actually rename, and we probably should rename insurance as the contingent capital markets. It's key pools of contingent capital that you need to know are there in particular circumstances, and the effect. And I think to your point around risk and these perception of risk, those views, many of them, almost all of them, if you like, around some of these new technologies, are actually wrong. Do not stand up to data and the proper analysis of data. And that critical next step that I don't think we've done, and I think actually that's because we've not had an active insurance industry in this space, which is translating all of that data. We have more than enough data and all the acronyms that come with it, ESG, TCFD, TNFD, and the rest of the alphabet soup. But what we have not done is that next step of translating all of that data into the only language that we speak when we make those asset allocation, those investment decisions, which is dollars. And I'm looking forward to sharing, I think, some of the specific examples of the products that actually are available in the insurance industry as we go through this discussion.
No, thank you so much, Anthony. So the contingent capital and how to really sort of unpack that and bring that into these projects at scale. And so there is some element of fundamental work that needs to be done with the business model of insurance, which I'm sure we'll get into. Moving forward, if I can take it one step deeper into transactions, into tools. So for HSBC, I mean, you facilitated innumerable regional clean energy projects, and you've been leveraging your global experience as well as innovative mechanisms through your participation in vehicles like Pentagreen. So what are some of your learnings from these experiences, and how do we kind of utilize this to replicate success at a much larger scale?
So I think this is a really important question because there's a lot of experimentation, there's a lot of innovation in a whole range of different areas, whether it's platforms that share risk and aggregate transactions, whether it is guarantees, which I think have an increasingly important role in this space. And there's been a lot of innovation there, especially among the MDBs and export credit agencies. Technical assistance, also very important. Some of the capital market tools that are being developed, very important. But I want to focus really in answering this on Pentagreen, because it's a platform that we're very proud of. It was established as a joint venture between HSBC and Temasek. And we're now in the process of scaling that vehicle, to your point, right? So it's not just a smaller experiment. It's now we're bringing in other partners, turning it into a blended finance platform, and where the thesis is that when you look at the infrastructure, sustainable infrastructure in Asia, we see a lot of need. Those numbers we were talking about earlier kind of quantify it. We see a lot of that need that isn't really bankable, could only really be met in the public sector or by development finance institutions. And then we see projects that are commercially financeable, but there's a large gap in the middle of kind of marginally bankable projects, where maybe the project is almost there, but it has certain features which just mean it's not in the current stage bankable in the market. So the idea of Pentagreen is really a blended finance vehicle that can help to finance those marginally bankable projects, make them bankable, and then bring in other financiers. And I think that as you look around the ASEAN region, you see a lot of opportunities in that space. I think that you mentioned what are the lessons to learn from these kind of experiences. I mean, the first thing to say is developing blended finance is complicated, and so and what you see in this space is often lots of very small-scale initiatives. And we haven't been very good at working out what works and then scaling up those initiatives. Everyone wants to have their own little thing. And I think that's something we need to get much better at in the blended finance space. For this transition to be successful, it has to migrate from being kind of talking point among politicians to being the commercial opportunity of the century. And so that means that blended finance also has to have a kind of commercial mindset behind it. And I think we're seeing more and more appetite for that from concessional financing providers. And I think Pentagreen is a great example where that motivation is coming to the fore. But I think understanding that you can't expect commercial institutions to behave like development institutions. You have to use the resources to enable the commercial motivation to drive the development. It's critically important.
Absolutely. The commercial, obviously, in it for the IRRs, for the clear sort of return mandate that they're working with, and the concessional needing that like impact perspective coming in very, very strongly. And you need a platform like, which sort of marries the two, and which is the job that Pentagreen is doing. So building on that, like with the Rockefeller Foundation perspective, I know that you supported the 3CI initiative, and you announced a pilot project with ASIN last year. We've had few announcements this week. Would love to know more about what are some of the progress here in that work. And again, back to the same question on scale. How do we take it beyond pilot projects into sort of decommissioning the 100 coal-fired power plants in the region?
Yes, thank you for the question. And for those who are not familiar with the acronym, the Coal Clean Credits Initiative, 3CI, is an approach to bringing what we call transition credits to the market as a new asset class. And the proposition here is pretty simple. If you close a coal plant early and you replace it with clean power, and you do this in a way that delivers local benefits, that addresses the needs of the local workforce, then you should be eligible to monetize those reduced carbon emissions that will arise from this transaction. But when we started this work 3 years ago, that was not possible. So we had 3 pillars that we wanted to advance. It was the supply of high integrity transition credits, demand for high integrity transition credits, and building an ecosystem for scale and integrity. And as you said, Kavita, we've announced a lot of very important milestone updates with our partners over this week in Ecosperity. So on the supply side, yesterday, Vera announced that their methodology that the Coal Clean Credits Initiative has been developing has been approved by Vera. So this is the first ever methodology that allows coal plant owners to do that, to measure the reduced emissions from this kind of transaction. If there are any coal plant owners here, this methodology is available for you to use. So we also, as you mentioned, announced, I should say, Eric Francia from ASN Corporation announced a joint venture to bring forward the first pilot coal to clean transaction. We always knew that it wouldn't be enough to do a methodology, so we've been partnering with ASN Corporation. And this JV will include Keppel, Mitsubishi, and Gen Zero as the core partners. The project itself is a 250 megawatt coal plant in Mindanao in the Philippines. It's a young asset. It will be retired. The plan is to bring the retirement date forward from 2040 to 2030 to replace that coal plant with 100% dispatchable clean power. That's mostly solar PV and battery storage. This will reduce 19 million tons of carbon emissions. So this is a really exciting kind of commitment from some very serious players to bring forward this first transaction using our methodology. Another exciting update, of course, the next question is, well, where's the demand for transition credits going to come from? And another exciting update from Nat Cohane, who I believe is here with us in the audience, from C2ES yesterday. Kinetic Coalition was launched. This includes a buyer's alliance for transition credits, which will enable companies to purchase high integrity transition credits to reduce their supply chain emissions. Kinetic Coalition has already been talking to this JV and talking to ASN Corporation. There are 20 companies, 20 of the leading companies globally are already involved in Kinetic Coalition. So we're really excited that the next step will be hopefully to announce some sort of more concrete action on the demand side by the end of the year. Finally, building an ecosystem for integrity and scale. Many of you may be familiar with the Integrity Council for the Voluntary Carbon Markets. The way our carbon markets are moving, we're building in increasing layers of integrity, and it's very important for the Rockefeller Foundation that we support that ecosystem. ICVCM is a very important layer of integrity. It has established a working group for transition credits, And this working group is bringing together all the partners across the ecosystem to set a high integrity threshold for transition credits. So our methodology will need to be approved by ICVCM to get its core carbon principle approval. And any other methodology that's out there should also seek core carbon principle approval. One last update on the ecosystem side. We're working in a partnership with the International Energy Agency so that they can evaluate how transition credits can contribute to the sort of business model for early coal retirement. And so that research will be ongoing. And again, we're expecting some updates by the end of the year. So it's been a great week for transition credits, if I might say so. Some very exciting updates. And I think, none of this would have been possible without many of our partners that we're working with here in Singapore, the Monetary Authority of Singapore in particular, NCCS, Gen Zero, and many others.
First of all, congratulations. Well done.
Thank you.
And I think we do need to unpack that demand piece quite a lot more, first of all, in bringing that legitimacy for utilization of carbon credits, as part of a corporate decarbonization plan. But moving on to Anthony, when we're talking about existing products which are there for sort of addressing the risks which are coming out of clean energy projects in Asia, and I mean, putting a spotlight on facilities that are not fully utilized, as well as newer facilities like the one that Howden is doing for the carbon capture and storage, which sort of sets the stage for insurance to come in and give that performance guarantee for the new technologies.
Yeah, I mean, I think well, firstly, in terms of examples of real projects, I just wanted to mention, we can't cover it all here, but one of the partnerships that we've entered into to try and catalyze, I think, this transition on both the supply side, insurers, and the demand side, those who need insurance to de-risk, is the 2030 Enabling Climate Insurance Breakthrough. It's a partnership between Howden and the high-level climate champions. And what we wanted to deliver last year in Baku, we had this conversation, was to demonstrate that we have the solutions. And we worked on a white paper, that made the point that we are simply not going to mobilize the climate finance that we need, the target that was agreed, unless we have this paradigm shift in insurance to de-risk and enable those flows. And we published this paper together with BCG and the high-level champions, the great enabler. But what was really important was to actually demonstrate with a series of actual examples. And I would encourage you to get that paper, The Great Enabler. It has, I think, 11 from memory, concrete examples that show the spread of solutions that exist. I think one of the really great things that Howden has done in building our team, the Climate Risk and Resilience team, is many of us have come in from outside of the insurance market. So we're asking very fundamental questions like, why isn't there a forward price curve on insurance and the risk? There is for every other critical business commodity and service, but not insurance. But you can't operate without insurance. But why does everyone just accept that you do not know what the price of your insurance is going to be, and therefore that risk, until 2 to 3 months before renewal, even if you're going to be able to renew that insurance? I mean, I think that's insane. So that's a sort of paradigm shift we need to see. But when I coming out from more of a climate finance background into insurance, I assumed the issue was because the solutions did not exist, and we were going to need to do a huge amount of R&D, innovation around the solutions. Actually, what we've discovered, what I've realized, is that 70 to 80% of the solutions already exist. There's just a real lack, I think, of understanding, different language, different approaches between the traditional, let's just call it that finance sector, and insurance, the contingent finance sector, if you like. So actually, if we can raise that understanding capacity, and we're working with partners like HSBC and the banking teams there on that process at the moment, many of the other banks. And let me just give you, there obviously isn't time to go for all 11 examples, but I think it is good to sort of put one example out there. You've mentioned the really innovative work my colleague Vipal Shetty is doing out of our Singapore office on carbon capture. We're doing similar, really innovative products around carbon market projects, or ensuring, uncertainty if carbon projects approval disappears, etc. But this session is all about renewable energy. So let's take a renewable energy example. So, and the wonderful thing about being at a broker is we can innovate, develop, products, and then we can work across the entire insurance market, every single insurance company out there. There's hundreds and hundreds of them. So Green Backer Capital sought to expand its portfolio of wind energy projects, but encountered difficulties in securing finance due to uncertainties over the unpredictability of wind resources and therefore offtake and revenues. So risk exposure, the viability in wind speeds cause revenue fluctuations, making it difficult to meet debt obligations consistently. This instability heightened investor concerns about the project's financial reliability. Greenbacker implemented a parametric wind proxy hedge with KWH Analytics and Munich Re. The hedge provided financial compensation when wind speeds fell below predicted benchmarks, ensuring steady cash flows despite those fluctuations. And the payouts triggered are independent of any physical damage. So what was the impact of that? Well, I mean, it's actually quite material. The hedge enabled Greenbacker to secure roughly 20% more debt capital by stabilizing those revenue streams, and each dollar of premium resulting in $6 of additional loan proceeds. You can see the value there. People quite often don't see the value of paying insurance premiums. And this innovative insurance solution allowed them to expand their wind energy projects while attracting more investors and growing even further in that sector. So in a sense, as I said before, it's all about efficient risk sharing.
And you really see the case for bringing in that interest like in early part of that project development cycle, so that they're kind of working alongside you to enable you to do that like more effectively.
Yeah, absolutely.
I'm going to take a question from the floor. Like I think you've sort of addressed the question on premiums and where it can come in, but a question for Sir Danny from the floor. You mentioned the need for increasing the bankability of projects, and what is your view of risk allocation between banks in assessing bankability? So in sort of the different spectrum of capital that's coming in.
So I think it's an area where we need to do some work. Looking from HSBC's perspective, I think that as we grow the business, we also have to look at ways to de-risk that business. So, and that's about not tying up our assets for a long time in individual transactions, but enabling that capital to go back into the next transactions more and more quickly. And when you look at the scale of the needs, I think velocity of circulation of capital is going to be a critical issue across the whole transition. And in a sense, to achieve that requires a partnership mindset. So whether it's working with development finance partners to make transactions more bankable, whether it's working with export credit agencies and other guarantee providers, whether it's distribution to get the assets into the hands of other kinds of finance, whether it's pension, insurance companies, asset managers, large fund sponsors who want to hold these assets for the longer term. I think we have to get better at making that system work more effectively and more quickly, so that commercial banks can do the part that they're best equipped for, which is financing the new transactions, supporting companies to develop projects faster. But then I think also, and this is where partnerships like Pentagreen I think have a big role to play, is there are parts of this space where you do need different kinds of capital to come in order to get those initiatives to bankability, where they can be considered by commercial banks or by other financiers at all. I think also, a lot of the technologies that are going to drive the transition in 20 years' time, they either haven't been invented yet, or they are being developed in early stage companies right now. And you see a big challenge, I think, in the climate tech space for ideas that get developed. They're developed to a small scale, but then the leap to project finance to large scale rollout is really a huge one. And that's another area where I think banks, we have a climate tech, we have an innovation bank which is working in this space to help bridge that gap. Yesterday, we launched a future industries partnership, which is designed specifically to support companies in that space in the hard to abate sectors. So, there are a number of areas where perhaps capital allocation needs to get more efficient in order to enable the new technologies to scale up at the pace they're going to need to deliver the goals that we all share.
No, thank you. And so de-risking is more or less like allocating risk to those capital who's best equipped to kind of take it and putting it together like in a way that works for all stakeholders coming in. Sort of like we're running short on time. So for my final question to the panelists, like to really end on that call to action, optimist note, what would be one immediate change that you would champion with your respective organization to transform the clean energy landscape in Asia? Anthony, do you want to go first?
I mean, I think just picking up, well, I could pick up on so many points. I mean, just on Danny's last point, I think we as an industry can play, again, a much bigger role in the analytics and becoming forward-thinking, taking a forward approach to analytics on new technologies. And I, can give you lots of examples where we can provide technology insurance and look at a lot of the testing of new technologies and actually, put our money where our mouth is behind those technologies. Allow startup companies not to have to put significant amounts of, VC capital in escrow because their technology is new, and it's, we can insure those things and allow that money to be used, more efficiently. But I think the one thing I think in turn, that could have a big impact is to very quickly raise the capacity and understanding on both sides of the fence of how each other work, and particularly I think on the demand side, the finance side, of all of the products that actually are already out there, and to bring insurers in much earlier on in the financing and structuring, and not do what quite often happens, which is days, weeks before closing. Oh, we've got these risks. Have you got a product? That severely restricts what the insurance sector can do. Bring us in at the table. So insurance becomes a much more strategic part of financing and transactions.
Thank you, Anthony. Joe, yourself.
Yeah, I suppose when we started this work, there was an element of hopeless and naive optimism. Luckily, we didn't understand carbon markets too well, because if we had, we wouldn't have put so much faith in them. We were coming more from a power systems perspective, and we were focused on high integrity supply, on pilot projects. And as we've, begun to get more confident on the supply side, we've pivoted more to how can we generate, hundreds of millions of tons of demand for transition credits, because that's what we're going to need by 2030. Like, we start from the perspective of we need to solve this problem. We can't just tinker around at the edges. And so right now we're mapping out the kind of potential support sources of demand for transition credits. And there's 4 potential markets. There's the VCM, the voluntary carbon markets. There's sovereign demand under Article 6.2 of the Paris Agreement. There's compliance markets and fungibility of voluntary credits into compliance markets. For example, the EU ETS is obviously the biggest one, and then CORSIA. So right now we're working, and what we want to work on between now and 2030 is mobilizing demand and a strategy to mobilize demand from all those 4 market segments. On the VCM side in particular, which is, I think, the market that most people are familiar with, there is a challenge, I think, around, accounting and claims frameworks that quite honestly stand in the way of impact, and I think put maybe sort of accounting purity before impact, and take a closed rather than an open approach to how we solve this climate challenge together. And so when it comes to one challenge, we really want to work with the kind of claims, the accounting claims and the net zero claims standard setters, and make sure that the standard setters reflect the specificities of this region and are anchored on what's needed for energy transition in Asia.
Thank you, Joe. And so, Danny.
So as I'm learning after 6 months at HSBC, for a commercial bank, regulatory capital is at the heart of everything that we do, and we're here in a space which is fast moving, where speed and scale are the kind of watchwords.
Yes.
And I think that what I see is that sometimes these innovative new instruments are not being recognized to the degree that they should be in terms of regulatory capital. So whether it's guarantees from organizations like MIGA, the World Bank's guarantee arm, for example, AB loans with multilateral development banks, or indeed the broader treatment of project finance, I think that we need to do a better job as a global community of ensuring that how those things are treated keeps pace with the purpose that they have. And I think I can say that here in Singapore, where the government, the monetary authority, is one of the most forward-thinking in the world. The Fast Peace scheme, which is also enabling and matching concessional investment into Pentagreen, for example, is a great example. There is a mobilization of resources and thinking here which I think other jurisdictions of the world could usefully replicate.
Thank you. If I kind of try to attempt to sum up this rich discussion, I think I would sum it up in 4D. I'm not asking you to buy the Singapore lottery. It's basically develop, deepen, demand, and de-risk. First, develop policy and regulatory certainty, as well as institutional capacity. We need to deepen local currency, domestic capital mobilization, demand building through standardized financial products, aggregated platforms, as well as securitization mechanisms, and finally, really de-risking projects using catalytic capital, carbon markets, as well as innovative insurance solutions. So thank you so much for your sharing today, and that brings us to the end of the session. Thank you.